In your latest piece, you talk about the Fed's dual mandates becoming dueling mandates. What do you mean by that?
Well, what I mean is that the Federal Reserve, of course, has two mandates, right? And they often refer to as the dual mandates. One is price stability, which is hopefully keeping inflation around 2%, and the other is maximum employment. Typically, economists think that maximum employment is somewhere between 5 to 6%. Right now, you have inflation running north of 8% according to the CPI metric, north of 6% according to the PCA deflator, and you have unemployment rate running at 3.7%, very close to historic lows. So the Federal Reserve can solely focus on price stability right now, but as they continue to tighten, the economy continues to weaken, the labor market will weaken as well, and then unemployment will likely start to rise, and it'll become more difficult for them to continue on politically as people face job losses. And I think those mandates will become dueling mandates, and it'll be less clear for them what they need to do then.
So let's talk stagflation. Which one do you see as the bigger risk, the stagnation of the economy or inflation?
Well, I think they're both risks, but I think the Federal Reserve is right to focus on inflation. At the end of the day, it's very difficult for them to control the supply side of the economy, but they can control the demand side of the economy. And inflation is felt by everyone. It makes it very difficult, particularly if you don't have a lot of income coming in and you're forced to make tough decisions between driving to work and groceries and things like that, with extreme food inflation being seen due to the war that's ongoing in Russia and Ukraine. So unemployment is felt most acutely by those unemployed. So I think it makes sense that the Fed focuses on inflation, tries to bring it down and gets things back in line.
So if and when there is a recession, how should investors prepare their portfolios? Let's start on the equity side. So do you like U.S. stocks or foreign stocks?
We continue to favor U.S. stocks. I think the strong dollar is supporting that. But the other thing I think is that when you look at the economic situation around the world, you see Europe facing a very difficult situation with extremely high inflation, and simply because they're exposed to the energy crisis and the energy flows through Russia to Europe. The U.S. doesn't have that situation. We actually have a sufficient amount of energy. We have access to natural gas, so I think the U.S. just makes a little bit more sense here.
Can we dig a little bit deeper and talk about the sectors that you like in the U.S. stock market?
Right. We're continuing to be defensive. We actually like healthcare, consumer staples, global pharmaceuticals. Those sectors tend to have positive earnings per share growth even in downturns. So if we are facing a downturn in 2023, on average it lasts about 11 months, we think those sectors are good places to kind of hide out until we get the all clear, and we think that the recovery is taking root.
Let's divide it up a little more. What about large cap versus small cap, growth versus value? Chop it up if you don't mind.
Well, I think this is a difficult year for almost everything, right? Asset allocation hasn't really worked. Bonds are down, stocks are down, but I think that will change with time, and I actually think that growth and small caps will probably be the first to recover. Is it going to happen tomorrow? I'm not so sure, but I would not be surprised by mid-2023 that we see those two coming back into favor.
You mentioned bonds being down, but yields are up, and that's an opportunity for investors. How should they divvy up the fixed income side of their portfolio?
Well, I actually think fixed income is more attractive, as you mentioned, and it's simply because the yields have went up so much. I mean, it's been many, many years since we've had attractive yields on treasuries, and now we have them. And if you think about inflation, the downside of inflation and simply sitting in cash is that 8.3% inflation rate means that you're losing 8.3% of your purchasing power. You can actually get some of that back by putting it in treasuries, right? If you have a 1-year treasury, 2-year U.S. treasury, you're getting a 4% return or so, you're recouping half of the loss of your purchasing power. So we think that does make sense in portfolios.
All right, well, thanks a lot for coming on and talking about it.